What role does insurance play in the last quarter of my life? Welcome back to Question An Actuary, where you ask and I reply. I'm Pramod Sharma. Question: What role does insurance play in the last quarter of my life? Answer: Congratulations on reaching this stage with financial security and good health. You still face the four actuarial risks which you can transfer with insurance. 1. Morbidity. If you become ill, how will you pay for the cost of your treatment, prescriptions, and hospitalization? Taxpayer-funded healthcare covers some costs. Beyond that, medical expense reimbursement insurance helps. You can get coverage from an affinity group, see QanA number 3. There are non-medical costs. For instance, you might need to modify your home or vehicle to accommodate a wheelchair. You might decide to uproot and move to a condo or retirement community. Less space, more rules, less control. Travel insurance can also help and might be available as an add-on to your health insurance. The big risk is that a legitimate claim may not get paid. Be sure to answer the questions on the application correctly, perhaps with help from your doctor's office. It's also important to buy from an insurance company with high corporate governance. That's a sign of keeping promises. 2. Disability. If you're unable to take care of yourself, who will? You may have a spouse as a caregiver, but how capable will he or she be? Is the burden you're placing on your caregiver fair? The costs of hiring help or moving to a facility can erode your savings quickly and create stress. If your spouse stays at home, you're now paying for two places. If you consume more of the assets, what's left for your spouse? Long-term care insurance provides money to use as you wish if you have a cognitive impairment like Alzheimer's or are unable to perform two or more activities of daily living. Examples are eating and bathing. Consider coverage on both you and your spouse. Sometimes children help with the premiums. 3. Longevity. Do you have income that's guaranteed to last as long as you and your spouse live? A life annuity provides income you cannot outlive. You pay a lump sum and receive ongoing income. You may not want to put all your money into an annuity, but maybe some belongs there, even if you have a solid defined benefit pension plan, which is essentially an annuity too. If you're not retired, you'll find interviews on Taxevity. Look at number 9 and 72. They're both aimed at small business owners and incorporated professionals in Canada. You'll find links below. 4. Mortality. Estate planning helps you achieve your wishes after you're gone. Do you have an up-to-date will and power of attorney? When one spouse dies, assets can often be transferred to the surviving spouse without tax. Ultimately, taxes and other expenses are due. Life insurance is often a cheap way to pay without requiring the forced sale of your assets in a bad market. You see, there's a deemed disposition in Canada. Tax is payable as if the assets were sold at market prices just before death. The gain gets taxed even though no sale took place. There's a cheaper form of life insurance called joint last to die, which pays a tax-free lump sum when the last surviving spouse dies. That's precisely when the money is needed. You now have more to give your heirs or a cause you care about. If you have a family cottage, life insurance helps pay the capital gains tax and provides money for the maintenance costs. For more about keeping the cottage in the family, watch Taxevity number 71. You'll find a link below. You are unique, your situation is unique, the risks you face are universal. By default, you are self-insuring. Your premiums come from your peace of mind. You might get peace of mind by transferring some of those risks to a conventional insurance company. What do you think? Provide your thoughts and comments below. For personal attention in Toronto, reserve time to visit the Taxevity Insurance Clinic.